Evening, ladies and gents. My name is Simon Brown, doing this evening's Power Hour. So this evening we're doing what I call my lazy trading system. Bit of background onto that. There are just some disclaimers and the like. Lazy trading system, I designed it in 2004. I adapted it from an Australian chap. I forget his first name. His surname was Guppy. I adapted it from a system that he used. He used a series of 6 moving averages. And for me, that seemed far too complicated, so I distilled it down to 3 moving averages. I've been trading it since January 2005, and it's gone through various iterations over the years. As I've tried to make it, in essence, more and more lazy in truth. I've now come across the part which I've now been doing for about a year and some change, which is probably about as lazy as I can possibly make it. What do I mean by lazy? Well, what I don't want to do is spend all day, every day, sitting in front of a computer screen trading the market. If I step back further, what I don't want to do is spend an hour or 2 every evening poring over a computer screen, determining what I'm going to be trading the next day. What I really want to do is spend about 10 minutes a week on the trading. That's what I'm trying to get to. And I've kind of got to it in this point here. A couple of important points. It is what we call a mechanical system. In other words, there are rules. There is no thinking. You simply follow the rules. So that's the first point of it. It is a trend-based system. I'm kind of trying to catch the trends. So when we get a nice strong trend, it does incredibly well. When the sub-indices move sideways, it does less well. And it's designed for trading indices. It works significantly less well on equities, commodities, and currencies simply because of increased volatility in those. So it works best on your indices. I obviously do it in the South African environment. People I know who are trading it on US, and one chap who's trading it on the FTSE index, and they say that it works on those indices as well. It should work on any index because of the lower volatility in those index spaces. So it is simple. It trades with a primary trend. I use technical analysis, but it's a weekly chart that I'm using. Hence, I only need to worry about it on weekends. I set aside 10 minutes or so on a Sunday morning and work with it then. Trading indices, it is ungeared. In other words, there are no derivatives involved. I'll touch on derivatives at some point. You certainly can use derivatives. In the past, I have used derivatives. The problem, as always, with derivatives is your drawdown when you have the losing streaks gets quite painful. And in a sense, I'm more comfortable going into a non-geared position and leaving it to run. I'm currently in a trade that I've been in for since October 2011. I've been long of the Indy 25. If I was in a geared position, I would have done nice, but I mean, my interest component would have cost me a fortune for a start. So I go straight to the ungeared, and I trade in the exchange-traded funds. That's how I get those index exposures to stay away from the gearing. So the 4 indices that I trade, I call them sub-indices: the Indy 25, FINI 15, Resi 10, the mid-cap. The mid-cap is the new one. RMB issued a mid-cap ETF about a year ago. Up until that point, there wasn't any way to trade it. Mid-cap is the stocks numbers 41 to 100 in terms of market cap. Your indies, obviously, your industrials, your FINI, your financials, and your Resi being your resource stocks. One of the benefits of ETFs is you don't pay STT, security transfer tax, which means that your cost of entry is 0.25% lower. It's 0.25%. It's small money, but every 0.25% adds up slowly over time. So those are what we are trading. Generates a small number of signals. My Indy has given me, I'll come up to charts in a moment, it's probably given me 4 signals in the last couple of years. It's not designed to give huge numbers of signals. It's designed to sit out for long periods and then get in and ride that trend for as long as possible. And you can be in trades that will literally run for years. As I said, I'm in one from October 2011 and another one from about November 2011. Sideways markets, obviously, it struggles. The problem with the sideways market in any trend-based system is that you get in and you get stopped out, and you get in and you get stopped out. So you've got constant cost of transaction on the buy and sell side, and of course you've got constant small losses. So how do I try and avoid that? I basically, I suppose in a sense, I hacked it, and I slightly increased my stop loss parameter. And I'll touch on that when I get to it. But what that does is it keeps me in for a lot longer. I don't have a cost of carry. My only cost of being in the trade is that I'm not earning interest on the cash. And if you put 25,000 into a trade, that's 25,000 they could have been earning you interest. Because I'm not in a geared position, there's no cost of carry, whether it be a single stock future, a CFD, a warrant, a share installment, an option, whatever it might be, there's a cost to be in a leveraged position. So I slightly increase my stop loss. That means I'm in for longer, and there's no real implication for that. If anything, it benefits me. Obviously, if I get stopped out, it costs me more in terms of loss. I manage that with my 1% rule. So it's the primary index trend, and I only trade in that direction. With all of my trading, the first thing I do is I say, what is big picture in this market? Are we going up or are we going down? And then I only trade in the direction of that big picture. And I'll delve into how I do it in a moment. In essence, if my big trend is up, I wait for my secondary trend to realign. In other words, big trend is going up, secondary trend, which is a shorter time frame, is going down. I do nothing. As soon as that secondary trend then turns up, realigned with the primary trend, then I get into the trade. What am I trying to do? I'm trying to catch the trend at the beginning of the trend. I don't want to jump on the bus halfway. I want to try and get it at the beginning and then run with it. As I said, using weekly charts, and then I add a third step to it. So first I've got my primary trend, then my secondary trend, then I get a trigger, and then I will buy a week later on confirmation. So there's 3 levels of getting me in, and I'll delve into all of those. We get to some pictures in a moment, and that makes it a whole lot easier. So how do I define a primary trend? I use 2 moving averages, exponential moving average, EMAs. I use them relative to each other, and quite simply, if the 30 is above the 60, trend is up, and I'm looking for long trades. If the 30 is below the 60, trend is down, and I'm not trading at all. I don't go short because I can't short an ETF without gearing. I can do it in the CFD, but I can't do it vanilla, 1-to-1 geared. So the first thing you look at is your 30 and 60-day moving average. 30 above 60, we're in business, we've got an uptrend, we're looking for potential long trades. At the moment, the only one in a downtrend is the Resi 10, which has been in a downtrend for much of this year. And that there we have the 30 below the 60. The others, the Indy, the Finny, and the mid-cap, all pointing up. My secondary trend, which is then what triggers the trade, again, exponential moving average. I use a 15-week exponential moving average. And when the price moves through the moving average, that is my trigger. So first I get 30 and 60. 30 above 60, primary trend is up. Then I say price on a weekly chart closes through the 15-week. Now I've got my trigger. If it is still green the following Friday at 4:30, I enter the trade. So primary trend is up. We wait for that price to cut through the 15-week EMA. That's my trigger. Confirmation, a week later, I want it to be green. So let's say we're sitting here on Friday. We get the close. We check the chart on Saturday morning. We see, indeed, primary trend is up. The price has moved through the 15 EMA, which means I've got myself a trigger. Next Friday, 4:30, if that index is green for the week, in other words, it is above where it closed a week ago, I will buy the ETF. And what I'm doing is I'm building wind at my back, building those layers of confirmation so that I get into less trades than potentially. Stop loss, I obviously exit on weekly data. I initially did a stop loss on a close below the 15-week EMA. That's a much more aggressive stop loss, excuse me, and gets you stopped out of a lot more trades. There are a couple of issues to it. Firstly, in a sideways market, you keep on getting stopped out, then you get back in again. That just costs you money. But more than that, even when you're in a strong trend, you get stopped out, and then literally a week or two later, you're back into the trade. There are 2 implications. Firstly, you're getting back at a higher price, so you missed some profit, and you've got 2 transaction costs. You sold on your stop, you bought on your entry. So I use a close of the 30-week EMA. Because I'm running risk management, my money at risk hasn't changed. hasn't changed at all. What I am prepared to do is when I get new signals, I will add to a position. I'll touch on that when I get to the pretty picture. Okay, so there's one of them. Here is the Indy 25. Oh, it's green. Weird. That's my 30 EMA above my 60 EMA, so my trend is up. There is my 15. The green line is my 15. So the red is the 30, red is 60, blue is 30, 15 is green. You can see that red candle in the circle that went down. I then had a green candle. We closed through the 15-day, and then the next week we confirmed, and that was my entry point. I'm going to come back to these charts again because pictures are best how we're going to distill it. As I said, I've left a lot of time for questions, and the video will be on the website tomorrow, and obviously you can email and contact me as well. But that's in a nutshell the system. My 30 moving average is above the 60, so we're looking for longs. My price cuts through the green, which is my 15. That then says to me, cool, there is a trigger. The next week we close higher. That is my confirmation. I would have entered on that second green bar, taken a long position in the Indy 25 ETF. STXIND is the code. Here, just for interest sake, is the Resi 10. You can see my 30 is below my 60. My trend is still down. Notwithstanding, we had an astounding day on the market today in terms of the resources. Harmony up, 17 or 18%. I mean, all the resource stocks were booming, ran through 10. It's going to be a long time before those moving averages cross and we finally get the 30 above the 60 and we get an uptrend. And what do folks then say? They say, well, we missed the turn. Yes, we missed the turn. Quite simply, if we're trying to catch that absolute turn, what are we going to do? We're going to get a heck lot of false catches. I mean, one day the Resi will turn and it will start moving higher. I mean, surely, right? It can't go down forever. So when it turns, it'll move, and weeks, months later, we will get into it. What have we got? We've got a sustained change in trend. This is not looking for quick stuff. This is looking for lazy. I want to spend my time on the beach drinking wine. Well, no, not at the same time. I'll get sunburned. But, you know, beach in the day, wine in the evening. Risk management, fundamentally critical. If you go to, there's a URL there, jol.20/?4j. It's a short URL. There is a detailed video on the 2% rule. I dropped it down to a 1% rule. And in essence, the 1% rule says I use only 1% of my cash at risk in any one trade. I'm not going to go into too much detail, but I want to touch on it so we get a sense. So if I'm buying at 41 Rand 80, my predetermined stop loss is 40.26. If I buy at 41.80 and I get stopped out at 40.26, my risk per share is R1.54. I stand a chance of losing R1.54 per share. What I then do is I divide that 154 into 1% of portfolio value. Next slide delves that in more detail. So let's say I got a 100,000 Rand portfolio. 1% of 100,000 is obviously 1,000 Rand. I'm still buying at 41.80. My stop loss, 40.26. My risk per share, R1.54. I divide the R1.54 into my 1,000 Rand. That is how much I'm prepared to risk. It tells me I go and buy 649 shares at 41 Rand 80 cents. If I buy 649 at the 41.80, it costs me 27,000 and some change. More importantly, if I get stopped out at 40.26, I've lost 1,000 Rand. Hardly hurt my portfolio. If I run this at 2%, and the 41.80, this happens to be the last buy signal we got on the Indy 25. 41.80 was the price. If I run this at 2% of my portfolio, the trick is quite simple. This trade, I then put 54,000 into the trade. No problem. But then what happens if I get a buy signal in the Finny and then a buy signal in the mid-cap? Suddenly I run out of money. So I drop it to 1,000. It gives me more space to enter trades, and it reduces my cash risk per trade, which is critically important. So some pictures. This is the Indy 25 weekly chart going back to December of 2010. The red arrows are the buy signals that we have had over the last couple of years. The first one you can see right down at the bottom there, which is going back to October 2011, which was an entry at about 27,000. And if you'd got in at that point, there are a couple of points I want to spend on this chart, so I'm going to dwell on a bit because there are a couple of important points. If you got in on that red arrow right at the bottom down there, and you are exiting on a 30-day moving average, which is the blue one, you are still in that trade. You haven't yet been stopped out. You got in at about 27 Rand. You're now a year and a half later, and it's trading at about 47 Rand. So you are, I'm trying to do the math, 85% in profit. You've also received dividends over the period. You've probably received Indy dividend yield, maybe 3%. So maybe you've got a couple of Rand in dividends at the same time. If you were exiting on the 15 moving average, you can see a couple of points where you would have got stopped out. You would have got stopped out at that second arrow, and then you would have got straight back in again. You would have got stopped at the third, and you would have got stopped again. So you would have got stopped at every one of those times. That's why I've pulled back and said I'm going for the 30 as my exit. I was in a trade, and I had got stopped out earlier. You can see at the chart down there, sort of early 2011. Indy was going pretty much sideways for a couple of months. And I got in and then kicked out and then in and then kicked out. What I used, so I entered this trade back in October 2011. What I then did was back in the second arrow, which was about June of 2012, my stop loss is now in profit. So if I get stopped out, I make a profit. So I've got no cash at risk, no initial capital at risk. So I added to the position at the red arrow, the third red arrow that comes along. Another 1% at risk. And when I saw this last arrow came along, which is now April of this year, again, I've got a stop loss, but my stop loss is well in the profit. That blue line is my stop loss. If I get stopped out, I'm still making a profit. So what did I do? For a second time, I added to my position 1% capital at risk. So my position has significantly increased over the period. So I've got one entry at about 26 Rand, I've got an entry at about 32 Rand, and I've got an entry at about 41 Rand 80, 42 Rand. So my position in terms of rands and cents is quite large. But in terms of risk, I've got 1,000 Rand risk in the trade. I've got about 65 odd thousand in the trade, but only 1,000 Rand at risk. And if I get stopped out, I've got profit of about 20 odd thousand profit in the trade in total. So I use those extra options to scale me in again. And the key point, as I said, if you're using the 15, you get a lot more kick out going. And what tends to happen is that we will often cut the 15, but we don't cut the 30. We get the pullback, and then the trend continues. Because remember, we have waited for a strong trend. That's why we're not getting into the resi early times when the trend is changing. We wait for a strong trend to have established itself. There's that same chart from earlier on the Indy. This was the April entry, just to reiterate it. Within that red circle, your red candle took you below the 15. The next candle, which was green, then closed above, gave you the trigger. The second green was then your entry into the trade. It was doing spectacularly well until yesterday, when the Indy was down over 1%, but it's still well within profit. Here are this as it stands right now. That trade, which was back in April, 649 at 41.80. As of 11 o'clock this morning, we were about 13% up on that particular trade. And our stop loss is sitting on the Satrix at 42.03, on the index at 42,030. So the stop loss is already in profit. The Indy has been a phenomenally strong index. Think about what's in it. Naspers, Richmond, SAB Miller. Stocks that have just been shooting the lights out. And the Indy has definitely been our top index. It's why when I initially developed this system back in 2004, I actually focused on trading the top 40. And then I thought, hang on a second, I want to slice and dice it. I want to nuance it. So I used to trade, then I was trading the Resi, the Finny, and the Indy. And the benefit of that was that, well, at the moment, I mean, the index has been, the Indy 25 has been the out-and-out performer because it hasn't got the resource stocks. So by going to the sub-indices, you get stronger trends that are going, and you remove those stocks that are weak, which are currently the resource stocks. There's your Finny 15. It's also given you 4 trades. It has, over the last couple of years, been largely in sync with the Indy 25. That's not always the case. And that trade back in late 2011 was about 2 months later. And in fact, the trade that came April now as well was a couple of weeks later. So it's lagging the Indy a little bit, and although it's done very well, it hasn't done the same level. It's up about 50% since that first trade back in 2011, whereas the Indy is closer to 80%. It's done well, but it hasn't done as well. Again, you can see the various different entry points. First entry back in 2011, a second entry running about June of 2012, which I used for a reload. I didn't add extra in that third arrow, which was October 2012, because it hadn't moved very far beyond my previous point. And then another entry, which I then took, which was right up here in April. If we delve into that, now you can see an interesting point. There are 3 arrows here. Firstly, my 30, which is the blue, is above my 60, which is the red. So I've got the primary trend up. The first arrow points to the bar, which closes through the 15 moving average. That gives me a trigger. My next week, I want confirmation. A green index. I didn't get it. I got a red index. So on that middle arrow, I didn't do a thing. But the index, the price did not go back below the 15. So my trigger was still valid. So the following week, now 2 weeks later, wrong button. I'm on that screen, that button. I then got in on the third arrow, got in there. If it had gone down through my 15, I would have waited for a new close above the 15, new trigger, new confirmation to come through. And some people look at this and say it would drive them crazy. Man, all this waiting. Now you get a trigger. 2 weeks later, you enter the trade. I mean, I have the ADD tendencies. I put my ADD tendencies into something else. I don't let it mess with my trading. Tried that before, cost money. So yes, it's designed to be lazy. There is the Finny trade from April. Using your 1% rule on a 100,000 portfolio, you bought 2,500 of them at 11.40, a fairly tight stop loss. Yesterday it was trading 11.88, so we're up, today at 11 a.m., all of 4.2% in the green. I've got a stop loss, which is still slightly underwater. So if I got stopped on this trade at the moment, I would lose money. I will update the stop loss on tomorrow, being Friday's close, because it's a weekly chart. So I take the Friday close. Here's the mid-cap index. I've got the index going all the way back in time, but the particular product to trade it only came in a year ago, so only those last 2 arrows back at the top were able to actually get you into a trade. But again, you can see, and again, broadly in sync with my others. And I got to say, I'm trading the mid-cap. I've put money into it. I'm doing it. I might ultimately in time abandon it because it's almost given me too similar to everything else. Too much in sync, and I'm actually looking for diversity. I like industrials versus resources. Resources being the absolute losers, that's great, we leave them. Industrials, the winners, we buy loads of them. For now, we've had 2 confirmed entries here, one back in late February, another one just last month in middle of April. If we delve into a close-up of the chart, what we got, again, there are 3 arrows because we got the first one going through. But a week later, it didn't confirm. The index came back. It closed below the 15, so all bets are off. A week later, we close above the 15 again, so we've got the trigger. And then finally, the following week, we get a green close, and we get that confirmation. This trade currently Wow, down 0.4%. Using the RMB mid, which is the ETF on the mid cap, bought 6,667 at 558. This morning it was bid at 556. I'm 2 cents underwater, 0.4 down. My stop loss 547. So my stop loss still, it's slightly moved up, but it is still underwater. And if I hit it, it will be a losing trade. There is the Resi. Actually not as ugly a chart as you think of when you look at it. But it does tell you that from July 2009, so what is that? Let's call it 4 years, the Resi has gone approximately nowhere. Actually, that's not completely true. It's up 7,000 of times 2. It's up about 15% in 4 years. The Resi's up 15% in 4 weeks. That's close enough to nowhere. A couple of points here. In the immediate, if we go to the far right-hand side of the chart, we can see that currently the primary trend is down. We're not interested in any trades in this index at the moment. There are some arrows. We've had some trades way back, and this goes back to February of 2010. It's the first arrow. We got into a trade, confirmed, stopped out. April 2010. Is it April? No, it's probably March 2010. No, sorry, completely wrong. It is 2010. It is October 2010. We got into a fairly decent trade on the India. The Resi. That is the last good trade I have seen on the Resi 10. That one got in at about 48,000, got stopped out at about 56,000, so about 17 or 18% ungeared. Not bad. Ran for about 7 or 8 months or there's about. What we're now seeing, we've had other trades. We got one there, which was a failed trade right at the top there. It had pulled back, it had stopped, it then went in, confirmed, and pretty much the week it confirmed, it then just proceeded to collapse. And then since then, hasn't given us any confirmation trades. And now we can see from that period there, we've actually just had a primary trend which is down, and that primary trend, it'll unwind itself, and certainly the gap between the two moving averages is starting to narrow, but it's going to take a bit of time to unwind. It will take a number of strong weeks, 6, 8, maybe 10 decent weeks for the 30 to get above a 60. Now I've got my primary trend up, but by then it will be well above the 15 moving average. So what I need now, a pullback to below the 15, and then for it to start to run. I was trying to simulate it on the charting package this morning, and it kind of indicated that, yes, it can happen, but I'm probably going to be 6 to 8 weeks at minimum, probably closer to 12 or 14 weeks' time, which is some 3 months away. And it will give you a level of around 52 or 54,000 on the index. So at a significantly higher level. And those of you who draw trend lines are putting a trend line across those 3 tops and saying that could be an ouch level to enter. It could. I don't put trend lines on it. I would get in on the system. I would trust it. I would obey it. I would set my risk management, 1% at risk. I would ride it without worrying about it. And if I get stopped, I get stopped. You risk very much a sideways market. We can see in some cases here, sideways market there, you actually stayed out to a large degree in there. But if we go back to that one there, which was way back on Indy, just trying to get it up on there. You can see that bottom left down there. I mean, even on a 15, I get in, I get stopped. I get in, I get stopped. I get in, I get stopped. That is 3 entries and stops in approximately 9 months. Each of them costing 1% of the portfolio. Maybe a little bit less because the 15 days moving up. But over that period of time, the market did exactly nothing. I mean, it bobbed up and down, but from the beginning of it to the end of it, the move in the market was 0. And that was one of the reasons why I distilled it down into individual indices rather than top 40. Because individuals are more likely probably to develop a trend, be it up or down, as towards an overall market. And if you look at overall market, your top 40, we've certainly seen it much of last year. It did well, hit a high in early January, proceeded to go sideways until August or September even. Within that sideways, it went for 8 or 9 months. What was broadly happening is industrials were moving higher, resources were moving lower. And some financials moving higher, but to a lesser degree. And because of the weighting, the higher weighting of the resources, they nullified the Indie and the Finny stocks, giving us that market that headed sideways. Your stop loss can be large in terms of rands and cents, but you manage that large stop loss with 1% rule. 1% rule is critical. As I said, if you go to the Just One Lap website, you'll see a whole bunch, and there I talk about the 2% rule. Here I dropped it down to a 1% rule, simply because otherwise I would be over-invested. I would simply put too much into it. And even running on a 30-day EMA as my exit, my stop losses are in the, they're running at about 3% or so, or maybe 4% or something. It's not been too extreme by any stretch of imagination. And at the end of the day, your risk comes out at 1,000 Rand, so we're not overly stressed by that point there. So it is, I mean, the point of it was simple, but in fact, I wanted even less than that. I wanted something, and if I step back to it, I'd spent 2003 and 2004 day trading the Aussie futures, making a living from it, but sitting in an amazing home office in Bertha's Hill. I had birds of prey and wild animals in Valley of a Thousand Hills, but I was watching one of my 5 screens. It was exhausting. It was completely and fundamentally boring. Excuse me. And the question was quite simple. Did I want to spend the rest of my life sitting in front of a screen, 5 screens, probably getting skin cancer as a result? Because, of course, you've got to have big screens. And there's no point if you're going to have 5 screens and having small ones. Trading the market, sometimes doing nothing for hours on end. Trading a 5 and 15-minute chart, which means you've got no time to do anything. Make phone calls, but you can't distract yourself from the market. I started drinking less coffee because I couldn't afford the toilet breaks. And that's when I knew there was a problem. And I'm at my desk every day at 8 o'clock because the futures market opens at 8:30. I finished trading at 5. Well, I used to finish at 5 o'clock. I closed with equity. I would finish trading at 5 o'clock, and then I would have admin, which would take me an hour or two to do. So I was working 10, 11-hour days. Yeah, it was a living. Short was a living. Make no mistake about it. But it wasn't a fulfilling way to make money. That was the problem I was having. And my wife would come home in the evening and say, how was your day? And I would say, oh, it was boring. And it was. So I thought to myself, okay, I want to make money from the market. Make no mistake about it. I like this market. Yes, don't get me wrong. It's a great way to make money. But I want to be able to make money without having to stare at screens all day. Why do I trade? I trade for freedom from ties that bind. What do I mean by that? I trade because I want the money, not because I want to be tied to a screen. If I'm tied to a screen, I may as well cut my hair and go work at a bank. I tried that too. Kind of semi-work for 4 years. So I thought to myself, okay, I need to get something that I can really, really do from the proverbial yacht in the Bahamas. Not that I know how to sail, but anyway. And that's when I started digging, probably around middle of 2004. Daryl Guppy, that was his name. So I found this guy on the Australian website, asx.com.au, which is the Australian Stock Exchange website. He had this system called the Guppy system, which basically used the moving averages. And I said to him, can I use your system? And he said, cool, as long as I credit him. Daryl Guppy, credited. But it had 6 moving averages. And it wasn't, you look at 6 and your eyes start going squiff, and then you need even a bigger screen so that you can check and 6 seemed like too many. So I pulled it back to 3. Initially, I was trading, back in those days, there wasn't a heck lot of options in terms of what you could trade. So I was trading warrants, and therefore I was trading on the top 40. So trading geared product, just trading top 40, and I was trading a daily chart. And for me, daily chart was lazy. I'd been trading 5-minute chart. End of day was lazy trading. And it was doing great, made money. Particularly, I mean, we had a crazy strong bull market, 2004, 5, 6, 7, probably the strongest bull market any of us have seen in terms of top to bottom move. So really, it did what it should do. In a strong market, it delivered humongous returns. That's all you expect of a system to do. Then I joined Standard Bank, and I wanted to make it a little bit lazier, so I moved it to the sub-indices, and I moved it to the ETFs, but I kept it on daily data. But then I was doing Indy, Resi, and Finny. And then we had the first big test of the system, because in a bull market, I mean, of course it worked. But we had the first big test. And the test was two parts: the turn from a bull to a bear, and then the collapse into a bear market. And I wasn't sure how it would handle these. I mean, I'd done the back testing, but I didn't know how it would practically handle. How much would my drawdown be? And in truth, it handled that turn beautifully, mostly because we turned on a dime. I mean, our market went up straight line, and then kind of like, 11 o'clock one Tuesday, it turned over and went down in a straight line. And during the bear market, it was beautiful. It said to me, stay away, don't touch it. And then it started getting me back into some trades late 2009. So I sat out for about a year and a half. Late 2009, it started putting me into a few trades, etc. Then, as I said, I was still at that point trading it on daily chart. I left Standard Bank end of 2010 with the sole aim of being lazy. I wanted to leave Standard Bank. I wanted to read books, drink wine. Actually wanted to join the professional surfing tour. Sorry, the senior surfing tour. I'm old enough to be a senior surfer. I'm just not good enough to be a senior surfer. So I left with the aim of being lazy, and I thought, well, if I really want to be lazy, let's turn this daily chart thing into weekly chart, so that I only have to open my computer once a week and delve into what's happening, etc., etc. The being lazy and the senior surfing tour didn't really work. I work harder than I ever have, and I don't get nearly enough surfing done into it. But the system has worked. And in a sense, it's done for me exactly what I wanted: a lazy trading system, 5 or 10 minutes per week. To which someone then tweeted me during the week and said to me, well, why don't you go really, really lazy and go to a monthly chart? So I had a look at the data, and I mean, broadly it would work. But I think there comes a point at which, when it gets so lazy, you probably fall asleep and forget to trade. So for now, I'm going to stick to weekly. So it really is simple, lazy system, 5 minutes a week. It is 3 moving averages. I use EMAs. Why EMAs? I like the way the EMA is structured. It gives more weight to the most recent period, least weight to the furthest period. That makes sense to me, as opposed to a simple, which gives every period equal weight. My sense is you have memory effect. You remember yesterday better than you do 15 days ago or 30 days or 60 days ago. So I like to weight to this side. 30 and 60 give me my primary direction. 15 gives me my secondary direction and my triggers. Monitor it weekly. So what I do is I download my data on a Sunday morning. I check if anything's happening, check my stop losses, and at 4:30 on a Friday, I may have to enter or exit a trade, depending if I have a stop loss or entry or an exit. So there are actually 2 points at which I have to put some effort in: my Sunday morning, and then maybe Friday at 4:30. Both of them merely a couple of minutes. It gives you very, very few trades. One of the things back in the day when I was trading index futures on an intraday chart, I mean, the person who was making a huge killing was my stockbroker. I would sometimes do 150 trades a day. Now, a trade is 1 is in, 2 is out. So 150 trades is 75 complete trades, 75 entries, 75 exits. 150 trades a day, at 30 Rand a trade, they were making 4,500 Rand off me. And they were doing nothing. They just provided me with charting software and a feed. I had to pay for the data. And I thought, well, you know what? Stockbrokers making money. I'm making money, but I'd be making a heck lot if I could lazy it out. And that was part of this as well. It's why I've gone away from gearing, because gearing's got that interest component built into it. And if you sit into a trade for 2 years in a geared product, even in this low interest rate environment, the interest starts to add up. Yes, you're ahead of the game. I mean, if the trend is in your way, that's fine. You've made profit, and only part of that profit goes back. But I remember doing one of these on a CFD and making, and I forget the exact numbers, I made like 48%. It was brilliant, and I gave half of my profit back as interest. Not so great. And also ETFs, no STT, so you save 0.25%. 0.25%, and it's small change, but 0.25% adds up. It's probably a bottle of wine. I typically measure things in bottles of wine. It's a good unit of measure, I think. In sideways market, it bleeds. In a sideways market, it's going to, your best case scenario in a sideways market is you don't lose money. That's the best you can hope for. In truth, you're going to get a few trades that you get into, a while later you get stopped out of. Your loss might be small, but you've got transaction fees coming into it at the same time. So sideways markets are not lacquer. That's why I moved away from top 40, do the underlying indices. The ideal portfolio size, and this is one of the killers, the point being is because you're ungeared, and you could massage the number down. I ran the numbers today. Could one do it on a 20,000 Rand portfolio? Yes. First point is only do 3. Drop the mid-cap, do the resi, the indy, the finny. The second problem was on a 20,000 Rand portfolio, your cost per transaction is going to increase because remember, the brokers have a 0.whatever% and a minimum. Most brokers, you've got to do a transaction of at least 10,000 Rand or higher to actually pay the 0.5. So your cost, when I do a trade on this, my cost of transaction is 0.72%. If I was doing it at the same broker, but I did a 5,000 Rand transaction, my cost suddenly jumps to 3.1. So my costs increase significantly. I suppose, therefore, if you're doing 3 indices, suppose you could take it the other way around and say you've got to do a minimum of 10,000 Rand per potential trade. Therefore, you need between 30 and 50 as an ideal starting point. And then obviously upwards from that. Legal stuff. I mean, an important point with systems. I have been presenting this trading system since 2005. And in various presentations over the years, and its different iterations that it exists in, I have presented the trading system. There are a few people out there I know who trade it, but I've probably shown it to 3,000 or 4,000 people. And maybe a handful, perhaps 2 handfuls, actually trade it. Why? Trust. How do you trade a mechanical system properly? You need to trust it. Can you trust some oak? Yes, I'm standing up here in front of the podium and I've got the doofer which I wave around, which gives me a level of authority. But innately, when you're staring at that trade screen and you click the buy button and that box pops up and says, are you sure? You're like, I'm not sure if I'm sure. Who's that Simon Oak again? You're not sure. That is the truth answer. And when you're not sure, what do? You dithy, you dather, you decide you'll come back next week, and it just doesn't work. The point of trading is discipline. When it's 4:30 on Friday, if it's above the previous close and you got the trigger, you've now got the confirmation, your job is click, 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 get in. No time for thinking and wondering if you're sure. So how do you trust the system? There's a much more detailed video, link is there, but I'll give you a quick description of how you trust the system. Broadly, 3 steps. Firstly, go get the data. Go get a software package. Your stockbroker's free software package will provide this for you. That was the other point I wanted, something you can do on the free software that your broker gives. That most brokers include in their monthly fee. And go and back test. Go back to 2000. Go back to 2000 and trade every single trade from 2000 on a weekly chart. Here's my triggers. Here's my entries. All the way back. 13 years of data. You will probably in those 13 years get about 20 or 30 trades. Did they make you money? Start with a fictitious 100,000 and 2,000. Do the 13 years of data. It's going to hurt your head, but that's fine. I mean, that's why there's red one. Do the 13 years of paper trading it, of testing it. See that it works. Did it make money? Now you've got first level of trust. The second level of trust says now you want to paper trade it. Now you want to do it in real time. The problem with this one, if you do it in real time, it's going to take you another 10 years to do 20 trades. So I say, okay, you're going to want to skip that point. That's fine. Jump in with real cash. Jump in with small real cash. Don't jump in with a giant portfolio. Make it small. Perhaps even so small that your costs hurt. Maybe put 20,000 towards it. So that you can test it with some money and your risk per trade is a couple of $100 and you're saying, I'm testing it, I'm going to see how it works. And slowly you start to build the confidence. And give yourself a time horizon. Say, I'll put 20,000 in, I'll try it for a year and a half, until the end of 2014 or middle of next year. 6 months is too short. In this system, you need to give it at least a year. Trade it for a year with a small amount of money. Did it make you money? Did it work? Understand that it might not have made you much money because of increased costs. But what you've done is you've essentially learned to trust the system. More importantly, you've made it yours. And if you want to tweak. If you want to make it daily instead of weekly, if you want to make it top 40, if you want to trade the Dow Jones Euro Top Stocks 50, if you want to trade geared rather than ungeared, if you want to trade it on the Aussie futures on a daily chart, I mean, it needs to fit your requirement. This fits me. This system is handmade for me. Of course it is. I made it. You've got to make it fit you. You've got to make it a system that makes you comfortable, that makes sense to you, that you enjoy trading. That's intuitive. And maybe you don't want to be lazy. I mean, that's the other side. Someone said to me a couple of weeks ago on Twitter, but what happens if I don't want to be lazy? Well, that's cool too. Then you go and find an unlazy system. I got those too. I can give you a 5-minute chart system. And you get calluses on your thumb. Question. We've got about 10 minutes. There's probably a bunch of them. I'm going to stick to a 6 o'clock finish. Appreciate people who've got places and things to do. I'm on TV at 7:30, so I can't stay forever, but certainly we can run late. And of course, you can get hold of me. Email is simon@justonelap.com. Excuse me. All my contact details, etc., are on my website. I'm perfectly easy to contact. Twitter, LinkedIn's, Facebook's, I'm on all of those sort of things. They're not showing up here, but you're welcome to follow up after the event. The video will be on Just One Lap tomorrow afternoon. But if there are questions right now. One question coming through. If you get stop signal, do you get out immediately or do you wait for 4:30 on a Friday? I wait for the 4:30 on the Friday. And here's why I do that. So there's risk and reward. So maybe the thing goes into stop loss territory at 9 o'clock on Monday morning, and I have to wait until 4:30 on Friday. One of two things happens. It moves out of stop loss territory and it becomes no longer a problem, or it moves lower. And I get stopped out below my stop loss. That's partly why I go to the 1% rule. There are a couple of reasons. That's one of them. I might take a bigger hit. When I run the numbers, unless we have a crash, and 2008 was not a crash. 1987 was a crash. 2008 was a swan dive off the top. We lost more in terms of top to bottom, but it took longer to happen. 87, we lost 22% one day. That was a crash. So I wait for Friday 4:30. In part it's because I'm trying to be lazy. Otherwise I've got to monitor it all the time and it ties me up, it doesn't give me that freedom, etc. And then it's a weekly chart, so I get out on the weekly chart. So it swings and roundabouts. If you get out Friday at 4:30, you get stopped less often, but you might exit at a lower point. If you get out as soon as it touches your stop loss, you will get more stops. Because what will happen is during the course of the week, come down to your stop loss and then move higher. Now you come down to your stop loss, move higher. I want to close on Friday. The question is, why do I trade at 4:30? Because I want to close. The rule is quite simple. So I get a trigger this Friday. It says, go buy the whatever. I want to buy it if my next bar is green. So in truth, what I want to do is buy it at 5:30 if it's green. But I can't buy it at 5:30. Because ETFs don't trade in the closing auction. So I could buy it on the Monday, but at 4:30, I've got a pretty good idea if this chart is going to close green for the week. And sometimes it's hit and miss. I mean, sometimes you log on and it's like green by like 12 points. So what's it going to do? Well, quite simple. I log on at 4:30. If it is green for the week, I buy it. If it is red for the week, I walk away. I make 4:30 my theoretical close. Practically, I can't. The system does short, the system does work with shorts, and the system does do very well in a shorting market because shorting markets or falling markets fall quicker than they rise. I don't short because I can't short an ETF without gearing. The only way I can short an index is to use a geared product, either a futures product or a CFD product or something like that, and I've moved it away from gearing. So one can do it, but then when I was doing it on an end of day chart, I used to use gearing and I used to do the shorts as well. Okay, yeah, I have. Why do we define it as trading? I used Trevor Manuel budget speech of 2007, 8, I forget which year. He stood up and he said capital gains, but basically he said if you hold for more than 3 years, capital gains, less than 3 years, income tax. So I use 3 years as my rule in the sand. To me, a trade is any transaction that is less than a 3-year duration. These are, I don't know. I'm in a trade here for 18 months. It might get to 3 years, but broadly, it's trading. So what does it do in return? And I've benchmarked it against the top 40 because that's the easiest return I can do. And I have benchmarked Resi, Indy, Finny, not mid-cap because I hadn't done the data yet. And the benchmark goes up to end of last year. Over the 10-year period, it outperformed the top 40 by a factor of 2.6. So, and that's costs included. So that's the buy Satrix 40, hold it. And I think your return was 18% per year if you just hold the Satrix 40. Trade this system over the same period, and you came out at 57, averaging a year. And it's lumpy. I mean, 2006 gave over 100. 2009, it gave 7. 2008, it gave 0. Because the market was crashing and I didn't do any trades in it. And that's to vanilla weekly trading ETF, not trade geared. Questions around, do I use other bits of technical analysis such as Elliott waves, trend lines, indicators, oscillators, MACDs? No, and no. I use 3 moving averages. And trust me, this is my complicated system. Hey, you must see my simple ones. There's no indicators. Yes, sir. Yeah, so I have other trading systems. I have my momentum system. Momentum system, quick analogy of that, quite simply, last day of the year, in the index that I'm trading, I run 2 momentums, a mid-cap and a top 40. Last day of the year, and you could do it any period, but last day of the year, I go and rank the stocks in the top 40 in terms of return for the year, including dividend, and I buy the 5 best performers, and I hold them for a year. End of the year, do it again. That system on 7 years outperforms the top 40 by a factor of about 2. I then am this year doing that in the mid-cap as well. So I now do the same in the mid-cap space, take the stocks number 41 to 100, rate them for the previous 12 months, including dividends. I buy the top 6, hold them for a year. That portfolio this year, my mid-cap portfolio year to date, excluding dividends but including costs, is up about 17.5%. My top 40 portfolio, excluding dividends but including costs, is up about 1%. So I'm underperforming top 40, I'm outperforming mid-cap. That system historically underperforms 1 year in 4. It's a relative system. So in 2008, the momentum system went down 11%, but the market went down 24%. So I win. I know it feels weird, but I win. In 2009, my system was up 21%, but the market was up 24%. I lose because the market outperformed. It's relative to the market. The back testing I've done tells me that I underperform 1 year out of every 4. And oddly enough, it actually seems to be every 4th year I underperform, which is weird, but anyway. Question coming through, what is average win-loss ratio since 2000? And I honestly can't remember. But I can't remember. But you certainly, it was around 40% winners, 60% losers. You lose more often than you win. The difference being is when I lose 3 or 4%. When I win, I make 60, 70, 80, 40. I mean, when you're winning, you're making double digit. When you're losing, maybe you're losing 5 or 6% worst case. Your winners are double digit, and if that Indy can carry on going, I'll get to triple digit. So the fact that I have more losers than winners is fine because my winners are markedly bigger. That's trading. It's not how many times you win and lose, it's the proportion as well between the sizes of the winners and the losses. As my trailing stop. So the 30-day is my stop on entry, which is, as you say, it's averaging 2.8%. Sometimes I've seen it as high as 3.9. I've seen it as small as 1.1. 1.1 is tight, but that's the system. Asking about change of trend, 30 crosses 60, start of trend, I do nothing. 30 crosses 60 is of interest because it tells me that the primary trend has turned from up to down or down to up, but that doesn't trigger a trade for me. The trade trigger is on the 15, price through 15. I'm going to recap to what I said a moment ago on that slide anyway, which is, this is a way to trade. Is it the only way? No way on earth. Are there other ways? Yes, this is my way. If you think you can make it work for you, if it attracts you, if you think you can work with it, by all means. You're welcome to contact me, simonbrown.co, my contact details, email simon@justonelap.com. I'll chat to you after, sir. If you think it's completely crazy, if you think that you've got ADD and you couldn't do an end of week trade if you tried, that's fine. Not necessarily for everyone. If nothing else, put it in your head, bounce it around, pull it apart, put it back together, see what you come up with. As I said, video will be on justonelap.com, let's say 5 o'clock tomorrow evening, close of business. Ladies and gents, thanks very much for your time this evening.